Hello friends, it's happening. Oil prices are surging past $110 a barrel. Tariffs are hitting the headlines and the stock market is officially crashing. The 6-month bull run is over. Everyone is scared, and if you're watching this right now, I know exactly how you feel. You log into your brokerage app and you see a sea of red. Everything you worked so hard to save is vanishing right before your eyes. You feel that knot in your stomach, and your finger hovers right over the sell button. Every financial news anchor is screaming that this time is different, that the sky is actually falling. Stop! Put the phone down. I'm here to tell you that absolutely nothing is broken. In fact, if you play this right, this crash could be the absolute greatest wealth building opportunity of the decade, but only if you know the rules. But first, a quick disclaimer. As always, this is not a financial advice, just educational content to help you think through investing ideas. Always do your own research. I wish you good luck. To survive a market crash, you must first understand the anatomy of panic. Wall Street actually makes billions of dollars off of your fear. They use volatility to shake retail investors, that's you and me, out of their positions at exactly the worst possible moment. Take 2022. I remember sitting there watching my S&P 500 ETF VOO drop 20% from its all-time high. I panicked. I sold everything to wait for the bottom. Spoiler alert. I completely missed the recovery and locked in real losses. It cost me tens of thousands of dollars in unrealized gains. It was the most expensive lesson of my investing life. Here is the cold, hard truth. When the news tells you trillions were wiped out today, they are deliberately triggering your ancient survival instincts. The same brain chemistry that tells you to run from a predator. They want you to panic sell your premium shares at a massive discount directly into the hands of institutional money. And here is something almost no finance channel explains to you. A stock market crash and an economic recession are not the same thing. A stock market crash is a rapid price drop, usually 20% or more, driven by fear, sentiment, and panic. A recession is 2 consecutive quarters of shrinking GDP, real economic slowdown. Here is the mind-blowing part. Markets can crash without a recession, and markets can recover before a recession even officially ends. In 2020, the stock market bottomed in March and began rocketing upwards months before government had even agreed on a recovery plan. The government is not the economy. The market is a prediction machine that runs 6 to 12 months ahead of reality. And this leads us to the most dangerous, wealth destroying move an investor can make: selling your stocks to wait it out. The math proves this strategy almost guarantees you will lose money over the long term, not because the market doesn't recover, it always has, but because you will always certainly miss the exact days that matters most. Let's look at the actual data from JP Morgan's Guide to Retirement. Over a 20-year period from 1999 to 2018, if you stayed fully invested in the S&P 500 the entire time, a $10,000 investment grew into over $64,000, a gain of more than 500%, simply by doing absolutely nothing. But if you try to time the market and you miss just the 10 best days in that entire 20-year span, that is less than 2 weeks out of the 7,300 days, your returns were literally cut in half. You would only have $29,000. You would have been better off leaving it in a savings account. And here is the terrifying kicker. 6 of the 10 best days in stock market history happened within 2 weeks of the 10 worst days. By panic selling during the crash, you permanently lock in your losses, and you're almost guaranteed to miss the single biggest recovery day, which erases months of pain in 72 hours. So, what you should actually do right now? First, let's talk about who you are. If you are in your 20s, 30s, or even 40s and you don't need to touch this money for a decade or more, honestly, you should be celebrating. A crash is a clearance sale on the best companies in the world. You simply keep your automated dollar cost averaging system running on full autopilot. When an ETF like VOO crashes from $480 down to $400, your automated monthly $500 contribution automatically buys more shares for exactly the same money. More ownership, less cost. Compounding working overtime in your favor. You are literally buying fractional ownership of Apple, Microsoft, Google, and Amazon on a 20% clearance sale. As a long-term investor, the crash is your best friend. The only thing that should genuinely worry you is missing this window entirely. Because historically, crashes are measured in months, but recoveries last for decades. But what if you are much closer to retirement? What if you are 55 or 60 and a 30% market drop actually threatens your ability to pay your living expenses next year? The rules change completely, and this is the part most channel gets wrong. They give you one size fits all advice. If you are near retirement, you need to play defense. That means ensuring a solid chunk, think 30 to 40% of your portfolio is in high quality dividend paying ETFs like SCHD. These are the dividend aristocrats, companies that have raised their dividend for 25 consecutive years through every single crash and recession in modern history. Companies like Pepsi, Johnson & Johnson, and Procter & Gamble continue paying you cold, hard cash every single quarter, entirely regardless of what the stock price is doing on any given Tuesday. You add 10 to 20% in a broad bond ETF like BND, and you have built yourself a genuine income generating bunker that weathers any storm. And for my Canadian friends watching, and I know there are tons of you, here is your specific playbook. You apply the exact same logic inside your TFSA or RRSP. If you're in the accumulation phase, keep buying VFV, which tracks the S&P 500 in Canadian dollars on discount. If you want automatic global diversification without thinking anything about it, XEQT from iShares is your one fund solution. 80% global equities, completely hands off. And if you need income and stability, ZAG is Canada's equivalent to BND for bonds. Load up your Wealthsimple or Questrade account, set your automatic contributions, and ignore the scary headlines with absolute confidence. Now, let's have a brutal reality check. I know it is extremely difficult to log into your brokerage account and see your net worth dropping by thousands of dollars in a single day. It physically hurts. It feels like failure. I have lived it. But that feeling is exactly the feeling Wall Street is counting on you to act on. But you have to remember, you haven't actually lost a single dollar until you click sell. Right now, you own real equity, real fractional ownership of actual businesses that sell toothpaste, smartphones, software licenses, insulin, and insurance policies. Those businesses are not going anywhere. They will be here in 5 years, 10 years, and 50 years. The stock price is just the market's mood that day. So, let me leave you with your 5-step crash survival checklist. Number 1. Stop checking your portfolio every hour. You are torturing yourself for no reason. Number 2. Do not touch your automatic contributions. Let DCA do its job. Number 3. If you are under 50, increase your contribution if you can. Buy the sale. Number 4. If you are near retirement, rebalance towards dividend ETFs and bonds. Reduce sequence of return risks. And number 5. Turn off the financial news seriously. It is designed to make you panic, not to make you wealthy. Every single financial crisis in history has ended. Every single one. The investors who came out ahead were the ones who kept buying when it was hardest. Go outside grab a coffee, and let your automated investments silently build your wealth in the background. If this gave you even one moment of calm in the storm, smash the like button. It genuinely helps this channel reach more people who needs to hear this. Subscribe for more rational, math-based investing content and drop in the comments. Are you buying the dips or sitting it out? I read every single reply. And finally, one last reminder. As always, this is not a financial advice, just educational content to help you think through investing ideas. Always do your own research. I wish you good luck. Keep stacking, set your robots up, and I will see you in the next one.